Yeah, seen a lot of you guys this week. Been very active and really helpful to a lot of traders. And so thanks for joining me today here on Ask the Pros.
My pleasure.
There we go. All right. Well, let's just jump in. We'll get started. And so, yeah, everybody, I was telling you before we got started that we were going to talk about the current market, a few things maybe to talk about there. I don't know, maybe some kind of announcement that came this week. I can't remember what it was, something with the Fed. All this kind of thing. We've got to talk about liquidity. We've got Garrett here with us. Got to talk about global markets. We got Roger here, experts on all of this. And this whole commodity super cycle, we talked about it a couple of weeks ago when Jeff Smith and Jeffrey Turnmeyer were here with us. I really want you to get their perspectives as well. And we'll bring it down to some other kind of trading ideas as well as we kind of go through this process. So first thing I got to tell everybody is, hey, guess what? There's risk in the market. You can lose money. You can lose a lot of it. You got to make sure you understand what you're trading before you click that mouse. It's your responsibility. And we're not here making, guarantees. We don't know what's really going to happen in the future. We're just telling you how we are looking at it and the types of tools that we use to do that, to help give you that edge in the market. And so hopefully we help to keep you on the right side of the market with that as well. So, but with that, let's jump in. Let's start with you, Garrett. Tell us, what is your current view of the market and the global markets as well?
So somebody was asking me earlier about the state of banks, because you're seeing bank stocks have really kind of peeled back recently. And the problem that we have in the system today is not an issue around banks and financials. It's really built around bonds and duration risk. So what's happening today, and I think what you're seeing the market is finally reacting to, is the rationality that we are going to be spending $5.2 billion a day as a nation every day through 2032. So that's going to create some questions for the next 12 to 18 months. And that really is the big question of who's going to fund all of this. Who's going to fund roughly $8.5 trillion in short duration bonds that need to be rolled over? Who's going to help finance a $2 trillion deficit, all while the Federal Reserve is reducing its balance sheet by another $500 billion? And what you're looking at right now, this inversion, I actually don't think we're going to be in a recession the way that they define it. But it certainly is a difficult case study when the 10-year is trading at about 4.3%. The 10-year, I think, is going to be on a slow march to around 5 to 5.25%. And that is going to weigh on risk assets, particularly equities. Now, at the same time, you have another element in place. Liquidity definitely bottomed out at the end of last year. Central banks have been easing. I think the Fed has been doing so very quietly. And you're going to have these kind of oscillations for the market. I anticipate that the market is going to continue to move higher, but it's going to involve a lot of these type of choppy type of events like we saw last year, where we would have a 40-point drop on the SPY in 8 or 9 days, and then it would recover and it would move a little bit higher than where it was before and would dump again. That's going to be the case until the Federal Reserve finally makes a decision. We'll keep moving our cut expectations out. We've gone from 4 to 2. I don't think they're going to cut next year at this point. So as far as it goes, it's just going to be really kind of built around the response to capital in the market, what the 10-year does. And it's going to take a little while, but I remain bullish over the very long term. And I'm looking for opportunities if there is a sell-off to start building more positions. Equities is going to be your way to help manage a lot of the challenges down the road. I don't see gold or some of these other things like duration bonds working out at all. In fact, I'm avoiding any bond over 2 years.
Nice. Interesting. Very good. Roger, what are your thoughts about the current market and global markets?
I think China is putting a real big uncertainty on everything. I think Japan is really slow to start doing what they should have been doing 20 years ago. And I think US is just sitting and hoping that things will get better and biding time. I don't believe anything the Fed is saying. I think they're completely, if you look at what they said 6 months ago, and if you look at what they're saying right now, it's like two different stories. It'll happen, but it's going to happen. I mean, they're just very, they're bad poker players. They really are. They're just not good at what they're doing. They don't have I don't think they have a good pulse on this market. I think they They don't respect the amount of lag the market has to really tell us what's going on. And I think they're mismanaging this country. That's probably the best way I could put it. They try to highlight every positive thing, but they keep avoiding the pink elephant in the room. And that pink elephant in the room is employment is great. Okay, fine. I'll give them that for the time being. But what about everything else? I mean, what about wholesale prices at a 14-month high? I mean, what happened there? I mean, did we forget to talk about that or something? I think they're in a bad position. And instead of just saying, hey, we made some really bad choices, let's get people here who can really help us and get out of this, they just keep digging themselves deeper and deeper and deeper and deeper. And I don't think that's going to have a happy ending. And I think the market is starting to react to it. Which brings me to something interesting. If you looked at the stock market a year ago,
and you can take over the screen if you want to, Roger, feel free.
Oh, no. It's all good. It's all good. I think if you looked at the market a year ago, they were raising rates at a 0.75 clip, and the market was holding on. Okay. Theoretically, we should be in a much better position right now because according to them, we're almost done. According to the plot line, we're almost done. And the market can barely, and the market has got lower highs. I mean, it looks awful technically. And I'm looking at it on 6 different screens. It's looking awful technically. So my question to them now is, what's the next thing you're going to do? How are you going to spruce up? Earnings are not going to be great. The 10-year just broke down, had a breakdown. I believe it was yesterday or maybe the day before. This week has been just a blur. So I'm not seeing any light at the end of the tunnel. I think that's really what I'm trying to say. I'm not seeing anything miraculous that's going to drive us home. Now, I'm not necessarily seeing anything horrific coming down the pipeline right now, but I just don't see anything great. And I think investment bankers are too. UBS came out this week. They changed their price target on the S&P from 4,400 to 4,600. Woo! I mean, we're really going crazy here. And I think Bank of America, don't quote me on the numbers, but something very, very similar. I mean, when I looked at them, they were. So I agree with Garrett, and I think I think in the short term there may be some things that they could say that will get us excited, but I think in the long term, we've just crossed the $1 trillion line with credit. I don't know about anybody else, but as long as credit card defaults continue, I don't care that the labor market's getting better. If the labor market can get as great as you want, we have an amazing labor market. Yeah, and our default rates are going up. What is that telling you? That's telling you that something is wrong with the labor market. So again, I think that we have a Fed that's on a runaway train, and they have no idea how to stop it. And they're hoping, and they're giving us the best case scenarios. But I think deep inside, I think they know that this is not going to end well. Sorry, I don't mean to be so into it, but I'm just frustrated with them,
I think I just want to add on something that you're saying, Roger, because I do think they know what needs to be done, but there's no courage to actually do it. So, and the reason is this. If you go back to the 1970s and you look at the tenure of Artie Burns, which went from 1970 to 1978, at no point does he say what the real problem was in the 1970s. He doesn't do it until 1979, and he doesn't do it in a speech in the United States. He does it in a speech in Yugoslavia, 6,000 miles away from Washington. And what he says is, what did you want me to do to contain it? Because we had OPEC crisis. We had Nixon taking us off the gold standard. We had the Great Society, that we were spending all of this money. We had all of these COLA benefits. He was pointing out that this was fiscal. And he doesn't say it a full point. He has had, and keep in mind, everything that we're doing today in the U.S. is the exact same things we were doing in the 70s. We have Great Society programs. We have a $2 trillion deficit. We're dealing with OPEC once again. It's the same thing. And no one on the Fed, and none of the 200 PhDs who work at the Fed are raising their hand in Washington, D.C. and saying, stop, don't run a deficit. Cut the deficit, bring it to zero, and the Fed could legitimately cut rates tomorrow. They could cut rates tomorrow if they balance the budget, but they're not going to do that. And why don't they do that? Because they want to fit in, because they want to be able to get jobs at Carlyle Group after they leave the Fed.
That's
they
right.
want to run Georgetown. They want to go back and be economics professors. They want to go to cocktail parties. That's it. I mean, they're human beings at the end of the day. And I guarantee you, Powell will eventually say what I just said, but he's going to do it 3-4 years from now when he's no longer sitting in that chair.
Yeah, it makes good sense.
Yeah.
Well, so let me jump back to you, Roger, and tell me, with this kind of perspective, how do you make money in this market?
Well, now let me go ahead and share my screen with you.
Okay.
There's fantastic ways of making money in this market. Let me just matter of fact, my folks have been doing pretty good
Yes,
across
they
the board.
have.
Not on this stock Carvana, though, I'll tell you. Oh, what a stinker this has been for us. We launched a new income program and it just went, I mean, Murphy's Law, right?
Yeah.
Anyhow, so I'm going to, Garrett, I'm going to go a little, my time view right now is going to shrink from a year to about 2 weeks. Okay. So just, and everybody,
keywords, everybody.
I'm changing speeds right now. Like I'm going from like pretty broad to pretty narrow. So don't confuse what I'm saying right now with what I said a few minutes ago, because we're talking on a different timetable. Okay. So right now, the market is sitting right now, literally right at or right below the 100-day moving average. And there's a huge support level here. Now, for the next day or 2 or 3, I think this level will hold. But over the next month and a half, 2-3 months, I'm not so confident. Home builders, Matt, what was that ticker? X? Yeah, here it is. Home builders broke that level. They broke that level, and I don't see an end in sight. If anybody thinks that home prices are going to go lower, let's go to Brooklyn. I got a bridge to sell you. Okay, home prices are not. Interest rates are. I mean, your mortgage may be cheaper now than it may be in the future because interest rates are still lower than they're going to be, and they are going to go up. That is a certainty. The question is how much and when they'll stop, but they are going higher. I mean, I think the Fed pretty much confirmed that earlier this week. So I'm expecting a little more downside. So how do I view the market right now? Well, I'm viewing the market as about, and I'm talking about short-term periods. I'm talking about 3 weeks, 2-3 weeks. I'm cautious and not that optimistic about the bulls. I'm actually probably 60-40 bears versus the bulls, simply because we keep knocking at these levels. And if you keep knocking at a door, eventually you're going to hit it and you're going to knock it out. So the good news is, and there is a silver lining, I don't think the current downside move has a lot of steam to the downside. I mean, if you see here the 200-day moving average, even the support levels are pretty there, and we're still in a very, very choppy environment. That may change as we get further into the fall and into the winter months, but for now, we are just chopping around. So my view is we have a huge sector mess right now. Sectors are completely out of whack. I mean, it's harder to gauge what's moving and what's not moving than it is to figure out what to buy, what to sell. Like, for example, let me just show you. This is 1 week, 3 weeks. Over the last 3 weeks, energy, utilities, financial, the Dow, blue chips. But today, for example, the technology is already up here. So when markets get defensive, we know that blue chips people start putting their money into utilities, into energies, into the financial, believe it or not. Financials have been moving up, and healthcare and the Dow. But if the market starts coming back up, they're gonna sell that, and they're gonna be buying tech. That's what's been going up for every rally we've had over the last 9 months. I don't think that's wise, but that's what we've been doing. The Russells, the mid caps, the retail, the home builders, the real estate, they're not catching a bid at all. So I'm genuinely very nervous about what's going to stimulate this market. So the way I would trade right now is I would only trade the strongest relative strength stocks and the weakest relative strength stocks. And I would leave everything in between completely out, because I think the markets those stocks are going to be the most sensitive to what happens in the economy. And just to give you an idea, I have a list of stocks here. So right now, 24-week highs, 6-month highs are coming into, oops, excuse me. Here we go. you could see all the stocks that are breaking out, making 24 weeks high. These stocks are bucking the trend. Now, here's the thing. Most of these stocks are industrial stocks, pipelines. There's not a lot of tech here. There's really not a lot of, if any. I mean, there's no tech. Sprouts Farmers Market, Vista Energy. I mean, maybe a little consumer discretionary. People want to sit in a comfortable chair, but for the most CBOE, but for the most part, I'm not seeing any crazy moves by the FANG stocks. The FANG stocks are actually not doing all that great. So the market is in a very precarious position right now. We're coming out of the summer. We still have to finish September. September is not a historically strong month. The question is going to be over the next few days, and I'll tell you from a market timing perspective. I know we have some folks here who were not in the VIP room today. From a market perspective, we need to see. We had a gap yesterday. The gap took us right through the 100-day moving average. Till this gap fills, or at least halfway fills, I'm going to be very, very bearish. My next thing is going to be, let me just blow this up. I don't want to just see if we can stay up above this line. I want to see if we can fill this gap and break up to the 50-day line. If we can't do that over the next 3 to 5 days, if we can't do that next week, and I think next week we'll see some accumulation unless we really close weak today. I think we're going to see some more buyers come in next week. But overall, this to me is more of a dead cat bounce than anything else, and choppiness or downside action. The fact that we're choppy near all-time highs is throwing a lot of folks off. But folks, we've been going sideways for 3 months now. We haven't seen any action from the market in 3 months. So don't get so hyper bullish because we're just not there. Be very defensive. Stick to trading outliers like technology or blue. Don't go like to the middle. Use sector strength wisely right now, and try to trade from both sides of the markets. If you're not trading puts and calls, you're going to not get the full benefit of what we're seeing right now. Sorry, Celeste, I don't mean to go on and on for hours, but that's kind of what I'm seeing right now.
That's what we want you to do. Go on and on for hours. That really helps us a lot. Let me move back over to you, Garrett, and 2 questions for you. Sure. One thing, you mentioned kind of this quiet easing. Could you, and I know you've talked a lot about the liquidity thing to us here. So I think we're a little bit familiar with how, the liquidity, that impact on the market being, bullish, bearish, for lack or more of liquidity. Could you tell us more about this quiet easing? And then also tell us, how you are planning to, make money in the markets. You with your perspective, how are you planning to make money in the markets?
Yeah, I mean, the thing that was posited by Michael Howe, and he's the author of Capital Wars. He effectively argued recently that the idea of them being bullish over the last or effectively stating that the liquidity cycle had reached its bottom in October was this idea that the Fed has effectively been secretly easing for a year. He wrote about this last year, or about 2 weeks ago, and the reason for this is that they're effectively quietly targeting bank reserves, is how he describes it. You kind of seen this, that there's ample reserves, roughly around $2.5 trillion right now on the lower bound. And what they're doing is they're effectively enabling a lot of capital to operate out of the repo markets. That's allowed us to see capital come off the sideline and move into equities. And that was one of the big things that happened. Everybody thought that the market was going to completely tank after the Treasury Department was done with its Treasury General account, and the market just screamed higher, and it screamed higher largely because there was so much money sitting in repo. And the thing about liquidity is that a lot of people think that it is just limited to central bank balance sheets. It's not. There's a lot of shadow banks. There's funds, it's really just about all of the capital and credit that is available, and everything that can be done for the purposes of refinancing debt globally, how that capital finds its way in the market. Now, Roger just kind of blew my mind saying, I'm going to go from a 2-year outlook to a 2-week outlook. Well, Roger, I'm going to really shake it up on you a little bit real quick. This is about a 2-minute lookout.
Oh.
And
oh man.
so this is what I've been doing on Fridays. Oh. And focusing on momentum. Momentum is negative right now. But what I'm showing you right now, that blue line is volume weighted average price. Moderna last week was in a breakout quadrant stock. So what I'm looking for is I'm playing the rules of the third standard deviation band. So this move right here, this spread right here, that's the first standard deviation. These are the second standard deviation of price. This is the third standard deviation of price. Stanley Druckenmiller in 2018 pointed out that the markets do not have much of a trend because of the sheer amount of algorithmic buying that happens when stocks fall into the third standard deviation. So what I'm looking for, and this happened last Friday, and I was with a group of people and we were sitting around looking for different things to trade. When these stocks are in breakouts and they start to move lower, there's still a little bit of juice to be squeezed. So we waited for this to kind of get back to the first band. We went up to the 113 call that expired that day. It was 41 cents. And you know what happened next. So, this turned into a 190% win for us.
Nice.
And that's the type of thing that I'm looking for. Today, this happened again with the IWM. You have this big sell-off, you hit the band, and then what happens? Reversal. So we saw the 177 call go from about 80 cents up to about $1.20 in about 15 minutes. And the way that I advise people to trade this, I'm using TradingView as this platform. The way I advise you is, look, you're buying an in the money call, or you can go up one deviation line if you want, but keep your stops tight. Just set a 10% stop. And if it doesn't hit, it doesn't hit that round. But if you miss 5 times and you hit once, you're going to make your money back, and you can do it pretty quickly. So once again, you're kind of seeing it just happened again. And a way that I advise people, look, you're going to buy 4 contracts, you're going to sell 1 here, you're going to sell 2 here, and your stop will be back here for everything else. Now, I don't like doing this every day, but you can use the SPY and the IWM and the QQQs, and it has worked. I was having a conversation with someone recently, and we were in real time. He's like, no way is this, an interesting strategy. And all of a sudden the SPY hits this line, and then it just took off the rest of the day. And I said, all you got to do is just manage your risk. I don't like doing this because I don't like to sit and look at my screen all day. I have other things I like to do. But if you are a day trader, and one of the things that you want to be paying attention to is just trading down here around these lines and looking for opportunities for these things to rebound relatively quickly, and you move on, and that's it. And the other thing that I advise people on this, you want to do it on the hours. So when it comes around 10 o'clock, comes around 11 o'clock, happens around 12 o'clock, that's really kind of been the optimal time to do this. You can also do it around 2 o'clock when institutional capital tends to come back in at the end of the day. So
interesting.
Just a different way to do, just a different way to trade.
Just to add to what Garrett is saying, we use the VWAP all the time and the deviations. Matt, my assistant, loves the VWAP. Most day traders use it. Cyrus, to answer your question, the reason it works is because every day trader in the world is using those lines, and they key off with those lines. So when you have the reason technical analysis works is because people are using it. So you don't want to use some weird technical tool that nobody uses. You want to use something that everybody uses: 200-day moving average, 100-day, 50, the big ones. And over the last 20 years, the VWAP has become a very, very popular indicator, and it actually works really well for intraday moves. And that was great what you showed, that, Garrett, but we use that as well. Very, very good tool. I like to confirm intraday moves. I like to use the 5-minute chart with the VWAP. But those are all really good examples, actually.
Excellent. Yeah, that's really helpful. We're going to try to get as many topics in as we can here today. I want to switch over here a little bit to this super cycle of the commodities. And if you can see my screen there now. And Roger, I believe you were the one that first kind of brought this even particular report from Goldman Sachs to our attention in Ask the Pros. I think it was in December. It was early in the year at least. And I know, Garrett, you've done some things recently with this whole super cycle and energy and everything. But there's this whole part of this underinvestment. I want to get your opinion on this. And then I want to get your thoughts on ways that our audience could position themselves to make money if this is in fact true, this whole super cycle, the commodity deal that Jeff Smith and Jeffrey Turnmeyer and I started that conversation a couple of weeks ago. So there's this whole process of saying, and regardless of, opinions on, green energy or not, or the different types of fossil fuels metals or, gold or silver or whatever, that there is this actual underinvestment where these companies did not use their capex, capital expenditures, to invest into their plants. They did not, produce more of the commodities. We see that playing out, and that Goldman Sachs is saying that this is something that's causing this to be a really underinvested super cycle, which could potentially make it even more super. And again, as I said, Garrett, I know you have mentioned some of these things, and Roger, you came from commodities, and Garrett, you have an incredible energy background economically and so forth. So I just wondered if we could kind of digest this a little bit for the people. What is this underinvestment? Is there really something to it? What does it mean? Here's a couple graphs here, showing how the commodities had been dominated by the dollar, according to Goldman Sachs, and the graph that they have there, the light blue line being the commodities index, the dark blue line here on the left being the dollar. And then you have the whole capex, the capital expenditures there on the right screen, just showing how they, really weren't investing in, some of their companies. What is this super cycle? What are your thoughts on it? What are the opportunities? What should we as an audience do with this information? Roger, why don't you go first?
Well, I personally think that I don't know if this is I'm not buying 100% into the whole the theory behind how institutions have been dealing with it. But I will tell you this, that generally speaking, commodities, when they tend to rise, I started out in this business in the commodities market, and I love commodities. And one thing I'll tell you about commodities, things in the world don't happen as fast as people think they do. It takes many, many years for trends to begin. For example, I remember when I first started trading in 2000, gold was $280 an ounce. So it and then it took a while for it to get up and then back down. So the point is this: if you look at the most commodity cycles, they tend to last a long, long time. They don't last 3 months and then they go boom. They last sometimes 5, 6, 7 years. And I think we're just in the beginning stage of entering a commodity cycle. And by the way, these commodity cycles tend to coincide with stock markets dipping. There's always a inverse correlation between commodities. And this is just economics 101. Yep. Garrett will tell you this is stuff. I mean, this is just real simple stuff here. But generally, there's an inverse relationship because commodities are more expensive, interest rates get more expensive. It's harder for companies to make money, lower profit margin, and so forth and so forth. Consumer staples go up, real estate goes up, and stocks go down. If you look historically, and Garrett, please tell me, I don't remember, 7 years is the average, 8 years, but I think the average is somewhere in that ballpark. And somebody mentioned Stanley Druckenmiller. Stanley Druckenmiller and Paul Tudor Jones both said about a year and a half ago that we're expecting a very choppy market on a real estate adjusted return, not real estate, on a real adjusted return for stocks. We may see a flat market, kind of like we saw through the 70s, where stocks did go up, but they were eaten up by inflation. So I think we're seeing the beginning stage of that. Maybe we started it about a year and a half, 2 years ago. But my point is, commodities are hot, and commodities will probably stay hot. I think energies are just beginning their move. I don't think energies are ending their move. Energies are not behaving like this is the end of their move. I think there's a lot of unknowns. I also think metals have a lot more to go. Also, if nobody's really talking a lot about this, but this war that we're seeing between Ukraine and the world, we won't really know. We really will not know where we stand with our chemicals and our food supply till this war is behind us. There's a lot of one of the reasons I think why Putin really wanted Ukraine was because of that. There's a lot of the breadbasket is right there. So there are a lot of natural resources that may be in a much worse position than we expected, and we really will not know. They can't send anybody there to look at mining because they're fighting right now. So I personally believe that we are in a commodity super cycle, and I believe we're going to see higher prices. And I think folks should be looking at this with a longer term trend, the opposite of how Garrett and I are looking at stocks right now. The ones that I like metals, I like energies, I like metals. And I don't think one of the reasons why commodities, I believe, and I'd love to hear Garrett's perspective on this, but one of the reasons why commodities have been subdued, if you want to use the word for it, has been because of the rise of the US dollar. But I think the US dollar, I think with what the Fed is doing, they're not going to be able to contain the US dollar for much longer. And that may cause a real strong reaction from the commodity market. So keep an eye on the US dollar, keep your eye on foreign policy. And again, and that's without even talking about China. So there's a lot of things right now in the world that are not clear. And when the world becomes very when the world becomes very fragmented in terms of how it's moving, how economy is moving, that's when commodities tend to rise.
Excellent. Great. Thank you for that. Garrett, what's your take on all this?
Well, if it's so easy to understand that economics 101, Roger, I don't understand how people in DC can't figure it out, because you explained it perfectly. You're right. I think you're right on Russia as well. I mean, most massive wars are commodity driven. World War II was a big, Lebensraum was the term for Germany's invasion of Poland. And you look at this, there's a couple of different moving parts on this. So first off, oil is actually cheap right now at $90 a barrel. And people sit here and say, wait a minute, you're out of your mind. Inflation adjusted, it was 156 in 2008, right?
That's right.
So it's still cheap. But there's a couple of different moving parts. One, you talked about a shortage of metals. That is a serious element, right? So the United States, there's a couple of different trends that I think are critical. We have a perfect storm of policy, supply, demand, legal, capital. All of this is all coming together at the exact same time. So one thing is refining capacity. Our refining capacity continues to deteriorate here in the United States. There was expected to be a lot more oil refining capacity in Nigeria. That collapsed this year. And Europe is supposed to bring a lot more online. So we're going to probably see some easing in the diesel markets at some point, because the crack spreads have been wild. But I'm still anticipating a lot of problems, because most refining that is being built in the world today is happening in China. And China's not going to be sending us diesel fuel at any given moment. So the first thing is supply. Supply remains a big issue, obviously, with OPEC in focus. But here in the United States, the biggest lesson learned of the 2014, last time oil prices were up at $100 a barrel, all of the producers in Texas turned on their taps. They expanded their production. They started producing everything they possibly could. Did Roger freeze, or did I? Oh, no, he's not frozen. He's looking up. Never mind.
You're not frozen either.
Okay, good. Okay, I got worried. So they flooded the markets, and oil went from $100 down to 40. And all of the institutions were very angry about that. So then what happened? These companies started to do everything they could to keep their investors in play. And in 2018, this is where they started engaging in what is known as fiscal discipline. And this was really built on the backs of the CEO of Pioneer, where basically they said, we're not going to increase production. We're going to reward our shareholders. We're going to do buybacks. We're going to pay down our debt. We're going to enforce and increase our dividends. We're going to ensure that they're going to want to be good investors. And with that, you're not seeing an expansion of production, a dramatic expansion of production, even with oil at $90 per barrel. We had an opportunity to fill our SPR, the Strategic Petroleum Reserve, at $20 a barrel, but it became political, as all things are. And now we're going to have to probably fulfill it again at $80 a barrel, and that'll take years. Mm-hmm. It's a supply battle. Now, cost of capital is another issue. Cost of capital for new oil well production was 8% back 2011. It was also 8% for solar panels. Today, oil production cost of capital is about 18 to 20%. It's 3% for solar. So that is an issue involving where people are putting their capital and how they're willing to allocate it. A lot of this has to do with ESG, but it also has to do with inflation. 20% of all CapEx this year was just going to keeping production where it was last year. That's going to continue to deteriorate. Demand is going to move to 100 million barrels per day next year. 100 million. That's a huge number. And then you have the legal issues. So the current administration, but just really Washington in general, really started to enforce things in the mid-90s, and they've gotten more powerful over time. In addition, we have sue and settle lawsuits. There's a small lizard in the Permian Basin that they want to explore shutting down production of new production because of the endangered lizard. Now, all of that sounds well and good, but when you get to Oregon, where we may very well have the largest lithium deposit in the world, this cauldron that they've discovered not too long ago, is they are effectively trying to shut it down on Sioux and Settle already. They tried to shut down Thacker Pass, which is supposed to be one of our big lithium mines, over a buckwheat. And it is a model, it is a business model within law firms and advocacy groups to try to shut this stuff down. And it's not going to lead to, an expansion of production anytime soon. Thacker Pass is so far behind. Now, keep in mind, if we do drill for lithium, and we may have enough lithium on the border of Nevada and Oregon to produce a car battery for half of the world's population, it's going to take a lot of diesel fuel to pull all that stuff out of the ground. And where are we going to get our diesel from? Well, our refining capacities are getting eaten up. I mean, it's insane. So you've got supply, cost of capital, legal issues, and keep in mind, if we do try to force these mandates on electric vehicles, we have to increase our copper production by 4x. We have to increase our lithium production by 10x. We have to increase our cobalt production by 10x. We have to increase our graphite production by 18 times. We've never increased an industrial metal production in 10 years by a factor of 100%. So all of this stuff is going to manifest in the next couple of years. These companies are not going to drill more oil. The metals and mining is going to continue to be under stress because there's not enough supply. And I anticipate that by 2027, 2028, oil prices will be elevated, and we are going to be begging U.S. companies to drill.
Yeah.
Yep.
Yeah.
And I think it's going to be an economic problem because we have the ability to drill and produce in the Permian at 35 per barrel, and it's going to fall to 15 over the next decade. So, I just look at it and I say, I want to invest in oil as if oil is going to be at $75 to $80 a barrel, and anything over that is just gravy. I think copper is going to absolutely rip at some point. I think we'll be looking at $8 copper again, but it's going to be some time and the easing component of this is really critical. China's very important in this. If they keep expanding their balance sheets, if more capital comes in, it's going to move into these assets. And it's going to be a very good time to be in this because that's how you address the inflation. It is the playbook from the 1970s all over again.
Sure is. Excellent. Garrett, how are you using this knowledge to make money in these markets?
So the one thing that right now, energy is actually, if you look at some of the stocks, companies like Occidental right now, they're pulling back. They've fallen. Occidental's gone from like 66 down to 63. There's nothing wrong with these companies, right? Oil's at $90 per barrel, but some of these names are selling off and people are freaking out over it. They're saying, if it's so bullish, first off, you got to stretch this out. You can't just look at price movement over the last 4 days at a time that a lot of people are panicking about bonds. And there's a lot of collateral issues in the market right now. You have to really stretch this out and look to the long term. So one of the things that I pay very close attention to is what executives are doing with their capital. Are they buying their stocks? So for example, CNX Resources, a big purchase happened yesterday. This morning, we just learned that HighPeak, HPK is the ticker. That's the CEO of the company just bought $8.6 million in shares of his company.
Nice.
Warren Buffett has been buying billions of dollars in Occidental.
He's been going nuts with that.
$57 per barrel. So what am I doing? I'm selling put spreads. I'm selling spreads under the CEO's where he's buying it.
Smart.
That's it. Because if he likes HighPeak at 1680, I'll love it at $15. So doesn't matter what the stock does. Doesn't matter if HighPeak goes up to 18. Doesn't matter if it pulls back to 15. Doesn't matter if it just stays range bound. I'm looking to generate 20% on my money on about an 80% probability of profit trade, based completely around what those executives are doing with their money.
It's a great strategy.
Is a great strategy.
Great strategy.
It is a great strategy. Excellent. Thank you.
So, yeah. And that is the basis for executive payouts. So
yeah.
Executive
payouts. Yeah. Is, you have any information that you can share with people that you could put a link in or anything, or
we'll throw a link into the chat. Yeah, no problem. And we just did a conversation about it yesterday. We're going to do another one tomorrow at 2:00. So
cool.
So definitely stop in 2:00 and we will be live. I'll walk you through basically a lot of the things I just talked about now, but really it's critical that people want to understand the strategy. I'll show you how to do it tomorrow.
Excellent.
Garrett, how far do you go in terms of expiration dates?
So right now I have gone out a little bit longer than I typically like to. And the reason for that is it's September, historically 1% down market. And you know what's going on in this situation. So, I've got stuff that's out to October right now.
Gotcha.
Around Oxy. But when we get out to, October, we get into November, December, I'm really going to be looking at a minimum of 45 days or less. But if we do it right and momentum is positive in the energy sector, these could be 2-week trades. And the one thing about selling puts or doing spreads, if you get a 65%, if you get 65% of the credit back that you developed from that type of trade, I like to take that right away, because at that point you're just sitting here waiting a month and a half, to try to make the balance of that. You don't need to do that. You can just roll that over and find another trade. Insider buying has been very, very weak over the last couple of months. So if we do get a sell-off, it could be a very, very busy time. And the one last thing I'll say about insiders, if you are wondering when the bottom is going to come in this market, if you any particular market, there's one chart that I'll show you real quick. And this is my favorite chart in all of finance. I think it is the most important chart in the markets.
Get a picture of this, everybody.
I'm going to send it right now. I'm going to share it. Here we go. So this is the collective insider buying and selling.
Wow.
Over the last 18 years. And we're going to pull the Dow on this. And you see this chart right here. You see these pops up here. This is the insider buying to selling ratio. This is where executives are buying lots and lots of their stock. And what are they doing here? They have called the bottom of every single crisis dating back to 2008. This is Lehman Brothers. This is the March 2009 bottom. This is right after Black Monday with what happened with the debt ceiling. This is the China crisis, the liquidity crisis they had. This is the October freakout in 2018 around bonds. This is the COVID bottom. This is and right here, there's October 2022. That's the bottom of liquidity in the global cycle. We've not gotten back to that point yet. But if you pay attention to this chart and you see this thing getting up into this range, you buy everything you possibly can. Anything that's not nailed down, you are loading up on it, because all the collective psychology of executives around the S&P 500 are all buying at the same time. And I will tell you this, they're a lot smarter than me, and they've consistently done that.
Yeah. Excellent. Great. Well, a lot of meat and potatoes today, right, everybody? Thanks, Garrett. Thanks, Roger, for that just wealth of knowledge that you both have shared with us today. I'm going to take over the screen here one more time. I'm going to share a few things with you. Yeah, you can get a recording of this whole thing. So that you can get that chart, Linda. You'll want to see it. You'll want to go back over this whole recording and get all that. Was a lot of great information. That was a great chart. Love that, Garrett. So, well, anyway, I was going to come on here and share a few things, what I've been doing in the background. Some of you have participated in this hard right edge that I come up with every month. I do it usually on the third day of the month, and I'm basically projecting what I think is going to happen. And so I had my projection for September. I actually did it on August 31st, and then updated it a few days later once we could get into the market. So I wanted to show you kind of what we saw there. But of course, there's risk in the market, and y'all need to understand whatever it is that you're trading before you ever click that mouse, because your capital is at risk, and we're just kind of showing you some ideas. And so that's what I am doing here. But what I said in the last day of August, and then updated the first few days of September, I said, hey, I think the market is going to pull down. Here's my hard right edge. What do they say? I'll cut to the punch. I nailed it. Okay. Cut to the punch. So you might want to listen. I said, hey, I think the market is going to come down, and we're going to either have this kind of bottoming out either at CPI time or at Fed time. And I put this blue line, this vertical line there to show that that's really the Fed day. That's where I really think we're going to have that a lot of action right there. And came down to this bottom. So let me just show you kind of what happened. Oops, I guess I said those were the dates. I was just showing you that, hey, I said on September 20th, that's going to be a really big day. This is what I did on the last day of August. I said CPI, watch out. I said, watch out for triple witching day, blah, blah. But this is what happened. It's exactly what I projected would happen. Okay. And I've said here this Fed day, this is what we saw, and kind of gave some of those projections from that. And I said that the reason I do this is to just give myself an edge so that I'm not feeling anxious in any kind of market, especially with the ones that are pulling back, and that I can just keep my head about me in trading, because I'm here to make money. That's the only reason I'm here. And so this helps me do that. And so I shared it with a lot of people, and they felt like it helped them as well. So, well, I've talked to my publisher, and they have finally convinced me to give to you something I have worked on since 2012. This is something that has really given me an edge. People have asked me for this. Well, it's coming out next week, and it's called Dark Money Trade. So I want to invite everybody to be there. I believe Tuesday and Wednesday of next week, you'll get emails, you'll get notification. You even are going to get the opportunity to register for it here today. That basically, I'm just going to kind of show you where I kind of enter in as easy as this. Now, there's more that goes into all of this than just that. Okay. But I enter here when I get this green arrow, I exit here at this red arrow. And these are some amazing trades. I'm going to explain it to you. And I hope you listen, because it keeps me away from the computer, lets me live a lot of life. I like to live a lot of life. I don't like to look at a computer. So here's a trade that in 2 months' time, 116% gain. I know that's not super exciting on Pepsi, but you're holding this for a long term. But what I really want you to see are some other trades. Eli Lilly, 388% there in 3 months. And I don't know if you remember, but I came on, I've talked so often about Lilly, but it's using this process, this dark money process, that led me to Lilly, and as well as some other trades as well. And I want to share that with you. Honeywell, I came out last several weeks and have been talking about Honeywell. For those of you who were in the True Trend Pro, when I did that masterclass not too long ago, I said, hey, keep your eyes on Honeywell, because what we noticed is that when that True Trend Pro kind of sets up, it wasn't exactly on Honeywell. It wasn't the perfect setup, but it had some characteristics that we look at very specifically for a True Trend Pro. I said, what we've noticed is that this kind of process in True Trend Pro kind of is a precursor to what's about to happen. And sure enough, a few days later, some other things triggered in my dark money policy that showed the way to this whole gain right here in Honeywell, this whole entire lift up in Honeywell, while the rest of the market in September was going, Honeywell was going up. It was great. And so I just put out in a newsletter today, I said, hey, watch now for stocks to put in these higher swing lows. And I put that in, bottom right there. I said, hey, just look, I don't know if it's going to happen or not, but watch and see if it does, because there's some things. This is not necessarily this is not what I'm trying to talk about with dark money, but I certainly look at this. But there's something about Honeywell that I think you need to pay attention to, and that's the seasonality. So not only did it populate for my dark money, but it also has some really awesome seasonality. I think you should pay attention if you like to make money. I know it's not a real flashy, exciting stock, but if you like to make money, maybe there's an opportunity for you. I don't know. But this has a seasonality. You can just look at the months. You got October, November, December here on the left side of the screen. Those are some pretty solid months, even into the beginning of next year. So, and you see that pullback in August and September. And then you see all of these different types of trade setups here in the middle of the screen. This is on 20-day trades. You can take a picture of this. Maybe this will help you out. Just some probabilities, just based on seasonality, nothing else. No technicals, no fundamentals, no tape reading, anything, just seasonality. It's a pretty cool thing. You can look at the 30 days all the way over to the end of the slide there on the right. A whole bunch of setups here. October, just look at all of those in October. I'd say it's a pretty strong opportunity. So also, I don't know if you remember back in October or November timeframe, I'm like, hey, General Electric. And it was like, man, everybody thought it was the stinkiest stock. And it was a stinky stock. I can understand why everybody thought that. I mean, everything, being kicked off the Dow, just a lot of trouble, really mismanaged. Well, what people didn't understand about General Electric is that, had a brand new CEO for multiple years who had a history, a seasonality, if you will, of success. And what people didn't understand is that it was not about electricity. It wasn't General Electric, but it was an industrial and a healthcare and a green energy type stock. They didn't understand that. And so I came in and say, hey, this is a value stock. And then there's that insiders Garrett was talking about. Yeah, I like the insiders that are buying that too. But the key too that really flipped my switch was this whole thing of professional accumulation. And I loved what Garrett was saying too, hey, the insiders, and he showed that really great chart of how when the insiders are buying and how they can really pick, bottoms of the market. Well, when we don't have all of that, we've got these professionals that are accumulating, and they're doing it for funds. They're doing it for a variety of things, and being able to piggyback on some of that is really, really key. It's complicated though. But what I learned back in 2012, this whole process really bridged a gap for me. And it's what allowed me to step away from the computer, not have to look at it, but get into some longer term trends, whether they lasted for a month or 2 months or 6 months, and be able to make multiple trades off of that same trend, like Eli Lilly stock or Honeywell or General Electric, and really kind of get in at the bottom, get in before some of the biggest moves in the stock were taking place. So I'd like to invite you all, if you're interested, they're going to post a link there in the chat that you can go and get registered for this event that I'm going to hold next week. And I'm pretty excited about it. It bridges the gap between a long-term investor and the day trader, real short-term swing trader. It's a beautiful gap. And there's a lot of insight that comes to trading this style that I'm going to show you all about next week. So
excited to see it, Celeste. This is going to be a lot of this is going to be good. By the way, GE was one of the best stocks last year, and we made a lot of money in many programs on that stock. So I wouldn't sell yourself short on that one.
Exactly. Yeah, it was. Thanks for that, Roger. Yeah, thanks. So there's that link, and I hope that y'all will join me, and really excited to bring that to you. So thanks for those kind words, Roger, as well. So
Perfect.
Thanks for that, Cirrus. Had that prediction, so there'll be more, and I've got some stock ideas for you next week coming with that dark money trade, so follow along.
Well, thank you.
All right. Hey, Roger, have a great weekend. Thanks for joining us. Everybody, thank you for joining us. Make sure you check in with Garrett tomorrow at 2:00 when he brings that energy kind of cycle to you. I listened in on that. It was fantastic. And
yeah, Garrett knows his stuff. He really does. I think he's a really good asset to the whole pub organization. Have a great weekend, everyone. And you as well, Celeste. Bye, everyone. Bye,
thanks,
Cyrus.
Everyone.
Bye, Dave. Bye,
day.
guys. Thank you, guys. Bye. If you need to email me, Roger@rogerscott.com. Bye.